Hello, everyone. We have Litan Yahav with us today. He is a serial entrepreneur and most recently with Visor. Litan and I met over our similar interest in real estate investments and sharing some of our best practices. And today we're actually going to talk about some of the things we found in terms of what artificial intelligence allows us, what it doesn't allow us, and honestly, how we can move forward in the real estate industry given all the data that's out there. So, Litan, welcome. Tell us a little more about yourself.
What's up, Vicky? I'm so excited. Thanks for having me on the show. Um,
Absolutely.
so, all right, let's just start from the basics. I'm not a tech guy, meaning I don't have any technological background experience. I'm not as smart as you are, and the whole tech world. I was in the Navy for 6 years, and then I went to study law and business in school, and founded a startup that did 3D imagery for diamonds. Totally different industry. We started to touch on sort of data semi AI in that diamond world because that business was photographing consistent images of polished diamonds for trading purposes. Now, once you have such a large data set, we do 7,000 diamonds every day. We wanted to sort of leverage this data set and to see if we can teach a model how to identify the clarity and color of a diamond based on our images. And so we thought about these different models or methods of like comparing two diamonds and asking a user to teach the model to say which of these two diamonds, is more yellow than the other or has more inclusions, and that way teach this model how to identify it automatically. And so that was a long time ago. That was like my first, I'd say, touch in the world of data and AI. Anyway, since then we sold that startup about 9 years ago, made some money of investing. I've been investing in real estate as a passive investor for the last 9 years. Quite a lot of deals with really good and bad operators and GPs. Learned a lot, and I love it. I love data. I think AI, obviously, like everyone, is sort of like we're only scraping the surface. And just like what we're working on now was about 4 years ago, we built a software to track and manage our own stuff, you know, private and public investments, automating that and everything, whatever. And that turned into a whole new startup, which is called Visor, which is what we do today. And there's a whole data play there as well. And we can dive into that if you want. But I think there's so much to talk about it and so many interesting things happening. I think a lot of it is fluff. A lot of like AI stuff isn't really AI. And, if a lot of this AI will be commoditized, and then it'll be, the unique data set that people have that will be the real value, and the understanding of that data set, and, prompting all that. So I think we're going into really interesting times, dangerous times, but interesting for sure.
Let's talk a little bit more about data because data is the key to all of this. I mean, real estate industry, especially the commercial side of the industry, is very segmented. So a lot of times you're dependent on that specific general partner, their track record, information around how they invest, how they run operations. It's very operationally and data focused, honestly, area, but it's also very segmented. How do you see that coming together with AI or data in general in the future?
So I think it's multifaceted. There's so many elements of what you just said that have data in them. There's the underwriting for the asset that the GP is going to buy, and does that make sense? Does the price they're going to pay for this, is it below market? Is it above market price? Like, that on its own is like, there are companies that are in that field of the data, like companies like Zillow and CoStar and other sort of like um, you know data sources that accumulate these huge quantities of data, have analyzed them, teach models, and then they serve as sort of a benchmark. Obviously, it'll get better as it progresses, and more data sets will interjoin into that. But that's like the fundamentals of it, right? Are they buying a property at a good price? And then it's sort of the value add components that they're looking to do with this, right? As you look at companies that monitor construction costs, renovation costs, there are a ton of companies out there. I have this whole list. Like there's Procore and what others, like Autodesk is really good at this probably, and Bentley and all these like platforms that are used for planning. Like these are all like on the funnel of that data, and they'll be able to grant a lot of like information. So there's like each level that GP goes through when they're doing a deal uses either their own data, but they're probably going to use other people's data because they're going to always have much more. But I tend to believe that the last frontier in, and that we're very far away from that, I think, even with the progression of AI, are still the foots on the ground,
Yeah.
is still going to be a very unique offering, that people have that experience with the boots on the ground. These are like, the technicians, electricians, the HVAC people. Like, these are people that, with all due respect to data, they're always going to be there. And their expertise will always, for the next, I think, 30, 40, 50 years, are still going to be key and more important than the data they have. I mean, data will help them fuel, and those that use the data will probably be better than those that don't. But anyway, that's a long answer to a short question. I don't know
No,
if that
it's
sort of.
very applicable. I think what I've heard as well from operators, they're like, sometimes I look at a spreadsheet and I'm like, this is a winning deal. I'm getting all in. And then we get on the ground, and a year later, it's not. It's not at all what I expected it to be. And then the opposite is true. The spreadsheet looks really bad, like it's kind of like maybe, and then they go in and it ends up being their star property. So there's that soft component to the whole thing that you can't always glean from the data. The question becomes like, what are those key things that GPs or like Fannie Mae, like what are the things that we could collect about that building, about that asset, that would actually help make that determination more clear from the start, versus waiting a year into operations to say, I don't know if it's really worked out the way I expected.
I feel it's like one of those things I want to ask, like ChatGPT. What do you think would be the answer to this question?
Right.
Uh,
Maybe we should try it out.
because it's not just about the building.
Yeah.
There's so many variables that need to be taken into account, right? Like, you look at a property that a GP, and let's just say of like a straightforward multifamily value add. I mean, there's also the neighborhood it's in, the employment in that neighborhood, the infrastructure, the schools, the unemployment, the median income. Like, there's so many things that aren't just about the property itself that will affect the risk of that property, of that deal. And at the end of the day, it's all about risk, right? It's like everything could be a good deal, everything could be a bad deal. It's just a matter of like, what's the risk, what's the chance of that happening. And then if that happens, like, from a risk perspective, like, what the returns need to be reflected in that risk you're taking, right? If this is a bad neighborhood that you're buying like really below market, there's risk, but at the other side, the upside potential is really high. And so, would a model take that into account? I don't know. I think there's so many parameters in that. But if you ask me, I think, and this is every LP will say this, and every GP will say this. The most important thing is like the horse you're betting on, meaning the operator. And then the question is, how do you use data to vet these operators? And that's like a key question and a key issue, because in AI, as you know better than all of us, like, you need enough data in order to learn anything. And many of these GPs, even if they're super experienced, the GP, they've been doing this for 15, 20 years, whatever it is. I mean, that's still not enough data to measure anything. They did 30 deals. Okay, so what? How do you? And so, I mean, I guess when you look at the bigger picture, when you do want to vet or compare these operators, these people, there will be key defining data points for each of these operators, both from the manager level and then to the fund level, and compare them apples to apples to other comparable fund managers and other things.
I
Does that
was
make
just
sense?
reading a book on this topic, Necessary Endings. And in the book, it said, they made an example, before you marry someone, you should check their tax record and their credit rating. And it's not to see how much money they have, it's to see if they've taken accountability for their promises. Like, do they file their taxes on time, or is an accountability thing? Like, are they good about that? Are they, their credit rating, like when they take money out and they promise something, they actually return that money, and how often do they do that? So I thought about it interesting, because when I was getting married, that's not, well, we were very young, and that wasn't even a consideration for me. But I'm like, well, is that a really good metric for measuring people or comparing people? I know China does some AI around that, where they track its citizens, and if they don't pay their stuff on time, they can't exit the country or even fly. So we're getting into some very interesting territory when you start comparing people against each other based on data.
Right, but here's the thing that we started with at the beginning. I think that those are really important points.
Yeah.
The credit score and all that. But honestly, that has nothing to do with AI. Like that's just there, and that's a thing you want to look into, right? I mean, it's like one of those things where at least in the startup world where we're in, right? Everyone wants to use the buzzword AI, and
Yeah.
then it becomes so like used often that you don't want to use it anymore because it doesn't mean anything.
Yeah.
But I think the example you gave is a really good example of data of situations where, yeah, you can use data
Mm-hmm.
to vet people, operators. It doesn't have to be using AI, but it's a data focused approach to doing business and to investing. And I think it's important to do that as well, even if there isn't any AI involved in it.
Yeah.
Yeah, and from a data standpoint, like this is public knowledge, right? So all this public data. So if even if companies go and build a model that goes and learns this information, there's no competitive advantage to any other company will go and do it because this is like common knowledge. Anyone can go and access a credit score. Anyone can go and access all that public information. And then there's a question, all right, from a business standpoint, from a company standpoint that's building models, how do they create a moat that is better than another one?
Yeah.
Like
And
that's
how
why
do
this whole yeah
yeah, how do you
there's this whole data war like you hear all these like podcasts and stuff about OpenAI teaching its models based on public information,
Mhm.
but they also buy data from companies, like and then there's so there's all this stuff, and then there are actual companies that go and buy proprietary data so that they have the ownership of the data. Like there are, for example, companies like Zillow. Right, Zillow knows what people search for, where they search for, like what motivates them to click this or click that. Like that's a crazy data set that they can teach models to perfect propositions, perfect prices, and they can sell that data to other companies who can leverage that data for other AI oriented tasks. I think like we do a lot of data aggregation around the private markets, specifically around LPs and GP deals,
Yeah.
but not only that. And that's proprietary. Like no one has that information.
Yeah.
No one gathers people's bank, reconciles bank transactions, and then links specific bank transactions to specific assets to know, right, these GPs and these properties and these funds are performing as expected in these markets for this duration of time for these types of investors. Like no one has a data set. And so that creates, a mode, a situation where we have this leverage we can use to bring more value to our clients, but also, to tap into this market, which is not transparent at all, and see how we can leverage this to build models on top of it so that people can make better investment decisions.
So tell me
Just
some
as an
about,
example.
like, if it's not proprietary, but tell me some of these models that you're building on top of it. What questions are they answering?
I mean, which asset class over the past 2 years has not missed any distributions, or which GP has not missed any distributions, or which geography has had the most stable returns? It's obviously everything together, intertwined. And again, our data set isn't big enough yet. Like we're training the model even from a smaller data set. Like we only have about, $5 billion of assets. It needs to be bigger than that with more consistency in like the reporting mechanisms. But the idea that we're already building the foundations in a way where we can teach a model on top of it will enable it to scale. That's one aspect. Like there are other aspects like we have, and this helps again on the private market data side. And this is things that other companies do as well. But we receive investment documents from our clients, analyze those documents, extract information. And so that feeds us the model I just mentioned, sort of teach again more and more about how the market's doing. But we also use the same approach to teach the model to better analyze documents and extract relevant information from these documents. Now that's more, I'd say, common. You can throw a document into ChatGPT, but we're focused on teaching it how to analyze these private statements from private funds. There are companies doing that as well, only that, but when we combine that with other information we already have, it creates a more stronger model.
Yeah, and
Um,
it's different formats. I mean, every GP has their own format of how they provide the information to you, so that probably adds some complexity to your model as well.
it does, but also makes it more powerful, right? 'Cause when it
Yeah,
works, but yeah, it is difficult, and we have a lot of ideas and plans to do with this, like down the road as well. Like, I mean, you can create a whole investment thesis based on historic performance of these operators, of the actual performance of them, the communication that they do, the market that they choose, the properties they close on, the time it takes for them to distribute. Or there's like all this stuff that we can then create maybe a whole model where we invest. We create, you know, a fund to fund model where we can invest with these guys.
yeah.
Um, so there's a lot of places we can take this. In addition to, you know, underwriting for LPs, there's a whole world of secondary markets liquidity for private investment that we're not even tapping into. There are companies that are trying to tap into it, but we can underwrite our clients based on their information so that they can then leverage that.
What does that mean? Can you explain underwriting? It's kind of a unique thing, I think. And
Well, underwriting. So when you go and you apply for a loan, you know, the bank goes and underwrites you, right? They want to make sure that you're a borrower that can return the payments, and you know, and nothing will happen to you from a physical standpoint. All these things that, you know, they check it off, so they define your risk, and then the terms are based on that.
okay.
And we have a lot of that information in our platform about all of our clients because, you know, everything is in the platform.
Mm,
And so if a client now wants to take a loan, let's just say take a loan, that's one thing. But more interesting is, you know, you and I are invested in all these illiquid assets,
right.
right? These funds that are sitting for 7 years, but 2 years in, you might need the money and you want to
Yeah.
sell your position to someone. There's a process that goes around you wanting to sell your position to someone else, which you need to be underwritten. That positions need to be, it needs to be verified that you're actually invested with that fund, that the performance is actually what you say it is, the documents are coming in, the GP is giving his approval, blah, 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 all that, so that you can then sell your position to someone else at scale that can be automated using all the data we have and AI model on top of it.
That makes sense. It's almost creating a marketplace for these type of scenarios.
Now that's down the road, like that's from a vision standpoint. We're
I
not
like
there.
it. I see it. Yeah.
Um, yeah, and
Because that's one of the, I think, in my mind, one of the biggest trade-offs, right? In this type of investment is that you have to hold it for 5, 7, 10 years. Who knows what's going to happen in that time and whether you're going to need that money. And so that's the additional risk that you can mitigate with this marketplace.
yeah, I have a whole approach to liquidity, which I don't know if it's unique or not, but I think that when you invest in illiquid assets, specifically real estate, but not just anything that's illiquid, it also protects you from making bad psychological decisions.
Mm,
When you look at the liquid market, like the public markets, when it's so easy to liquidate your position to sell the
yeah,
stocks you own, most people will make a mistake and they'll be afraid because the market is tanking, and then they'll sell their position, right?
right.
Which is
Because
usually a mistake. You usually
yeah,
do not want to sell when it's down.
yeah,
In the real estate market, it's so much harder to do that. It helps you, you know, pull through those hard times where the market tanks,
yeah.
but you don't sell. So I think that I don't think liquidity or illiquidity is a good or bad thing. I think that sometimes it does protect people from making bad decisions. And the flip side of that, I think personally, every single asset is liquid because you can always sell it at a discount.
Right,
If you own a house that's worth, let's just say, $1 million on Zillow,
right,
and you want to sell it, you need the money, and you're going to sell it for. I'm going to go extreme here and say you want to sell it for $100,000. You're going to sell the house in 5 minutes. Like
right.
that's liquid.
Yeah.
I assume 500,000 as well, but like I'm just saying, liquidity or illiquidity is something
Relative.
that
It
people
assumes that you want to make the money on it, right? Or at least
exactly,
the money that you've invested.
exactly.
Yeah, and I understand. I like that approach to it. It's a hard one for me who's very risk averse, right? Because to me, that's a lot of risk. Yeah, sure, I can sell it for 100, but I just lost whatever 900,000, right?
Well, you're not really. I mean, once you invested in the private markets, that means that you're not that risk averse. You have a risk appetite if you invested in the private markets,
Yeah,
right?
right. There's
Um,
a lot of
so
risk. The risk that comes with trusting a GP with their operations, right? The risk that comes with just the trading and other contracts. I'll tell you a scenario. There's a company we invested with. They made two separate deals, but they made a really bad decision on one of their deals, but it impacted all their deals. It was like domino effect. So the question then becomes, is like, to your point around GP, is like, when you're investing, the GP and their reliability and their decision making doesn't only impact that one deal, it could impact any deal you've made over a lifespan. So that's the additional risk.
Right. I think that's pretty rare, but I think, yeah, that sucks.
Yeah,
That does suck.
it does.
Um,
Yeah.
I've always betted on, the smaller guys that do one deal a year,
Yeah.
maybe two, where each deal they're going to go all in and make sure that deal is like successful. And I've personally, I've stayed away from the big guys. That doesn't mean they're good or bad.
Yeah.
I'm sure that there are some big operators that are really good. I know there are, but yeah, I mean, yeah, choosing the horse is the biggest decision.
It is.
When you think about the passiveness of private investing, it only becomes passive after you find those people you can trust.
Yeah.
Up until that moment, it's pretty active finding those people.
And finding those people is hard, not just finding them, but finding the ones that you can trust. And I think, talk a little bit. I know you started a podcast as well where you look at different GP deals. And what are some of the maybe discoveries or just conversations that you've had as a result of that podcast to kind of evaluate the data that you see in there?
Yeah, so just to put us on the same page. So yeah, we started, me and two other sort of experienced LPs have started publicly reviewing decks, pitch decks from GPs, private equity real estate GPs. They gave us their consent for us to publicly review these decks. But then what we do is we open the deck and we try to be very balanced in our review, although some of these decks, needed a lot of work.
Yeah.
And then we review them, and sort of you get to you see sort of the consistency between decks, where there's a deck that was put together by a GP who has more experience as opposed to GP that has less experience. You can understand sort of from the deck structure if deck was intended for people that are like really sophisticated investors,
Yeah.
or if this deck was intended for people that are looking for the fluff and you fall for that type of stuff and not like the core details. I think a good example is like we went through a deck that was it wasn't even it wasn't a PowerPoint presentation. It was just a PDF,
Mm-hmm.
and it was super detailed.
Okay.
And now for me as an investor who really trusts or trusted his gut
Mm-hmm.
and didn't really go through all the details, I'm like, I'm never gonna go read this whole thing.
Right.
It's like I'm gonna find something that I trust, and I'm gonna ask him to read it and tell me what he thinks. But when you dive into the details of these things, there are core components that are missing from other decks that appeared in this one, for example. And so there are different decks, different data points. I think it's interesting. I don't think, we're at that point where we can say there's enough data to go and build a model around it. Maybe at some point when this grows to be really big.
Yeah.
But
Tell me about just like
yeah.
3 bullet points. Like when you look across these decks, what are the things that kind of like you pay attention to every time? And then the rest is kind of frivolous information that you kind of look through but not pay attention to.
I think, the number one thing is you want to see transparency. It's super important. And you can see in a deck if there's a lack of that, and not because they're bad people or because they're, trying to scam you, because they're trying to emphasize things that otherwise shouldn't be emphasized, but they should focus on, the more risky aspects of it. So for example, and I can say from a personal standpoint, I'm fine investing with inexperienced operators. I'm fine with it. That's okay.
Yeah.
But it needs to say, black over white, like this is our first deal. We've had experience in single families. We've had this. Because it's our first deal, there aren't any fees. Because it's our first deal, the waterfall is going to be super investor friendly. I don't know, 90-10 with a 10% pref. Like, something that super makes sense. And this is the deal. This is the pro forma. So that's like, the transparency around, the experience they have and all that. The second thing is like diving into the plan. There are GPs that don't go over the plan to detail. They're going to increase rents by 60% in the first year. That's the business plan. Okay,
Right.
how?
Right.
Like, what are you going to do?
Yeah.
like how is that going to work? You need to you want them to address that, and then the comps again, the details. All right, how are you reaching the numbers of this rent? Like, are there any comparables? Now it's fine if there aren't any, but it needs to be transparent. Like again, don't show me the fluff. Don't try to sell it to me. Like I mean, yeah, you need to sell it to me, but like give me all the details so I can make an assessed decision. Again, it's all about risk management. It's fine if the deal is riskier as long as the upside makes sense for me. And the third thing, which you don't see in a lot of decks, but when you do, you want it to be presented appropriately. It's okay when there's a partnership between a capital raiser, an operator, a property management firm. That's fine. That's not all the same person. But give sort of the background. Like, have you done anything before? Where do you know this person from? Why do you think this will work together? Like,
Yeah.
So I mean, because again, it's all about the people, and so I think those are like the core. There's a lot of other aspects of it, and I'm probably the least experienced out of the three of us. Like they have like those two other guys. Like I learn a lot each session, and I've done a bunch of deals already, but I feel like I'm always learning more from all these guys as well. Yeah, it's super interesting. A lot of interesting stuff.
And I love how you say, no matter how much technology we can put on this, no matter how we evaluate the data, it comes down to the people, right? It's that soft side of this whole thing. So the question that keeps coming up in the back of my mind around this is the sentiment. Like, how do you gather that sentiment about these people? Like, are they the right, to your point, what are their relationships? Are they the right people? How will they act? Like, there's always that gut feeling we have just from meeting many people, interacting with people, but we also have a lot of biases as humans, right? So what is your strategy for evaluating people that you entrust your capital to?
I don't have a scientific answer to this. I'd say yes, it's my gut most of the time, but it's not just my gut. I put myself in an environment where I'm surrounded by people I trust, and
Yeah,
usually I'll invest either with one of them or someone that they trust.
makes
That
sense.
and it's really dangerous, right? Because you have to avoid the herd mentality when
Yeah,
it comes to these types of investing. I'll still vet the deal and I'll still meet with the person. I'll still get my own vibe check for that person or for the operator. But it's really important for me to know them, meet them, and get a feel that this person is trustworthy. They know what they're doing and they're not going to screw me over.
yeah.
And so I do that by the people around me and around them.
No, that
That's
makes
also one of the reasons. That's also one of the reasons that's really hard for me to invest with the big guys because it's so hard to create
to know
that
all the
personal.
people in that company. Like, if they have 2,000 people, you're never going to know them.
Even if I do, it's just hard. It's harder. I'm not saying it's not. I don't do it. I'm just saying it's harder to have that feeling of trust. It's
Yeah.
still there. Like there are really good operators that are big out there. I'm not saying there aren't. Just building that trust is more difficult.
Yeah, it is more difficult. It's funny because when I think about it, and maybe because I grew up kind of investing in mutual funds, so I'm always seeing, like, think about its diversity. Well, if this company's managing 5 billion or whatever the number is worth of assets and they have 2,000 people, in my mind, I don't know why, it's almost like a safety thing. Well, if there's so many people doing this, it's less risky than one guy out there trying to fix up the apartment building by himself somewhere in the middle of nowhere. I don't know why. Again, it might be just my kind of,
I know there's total merit to that. I think when you look at diversification is really good to lower risk, 100%, but it also lowers return. And if
yeah,
you're looking for diversification, go invest in an index fund. Don't invest in a single
right.
asset or a single operator because you're increasing the risk, but you're also supposed to be increasing the potential return,
Mm. That's the key.
right? Right,
Yeah,
because you put money in S&P 500, you're going to make 9-10% annually over the years. Like that's what you're going to make if you're fully diversified across the top 500 companies in the stock market. You ask me, I think that's low risk. I think that's super diversified. You don't touch it. It'll
yeah,
sit there for years, and it should over time make that return.
right,
As opposed to a real estate deal where you might not, but the upside there is making 17% IRR,
right.
right? That's 70% higher than the S&P 500.
Hmm.
70%. Like people look at it's only 7%. No, that's 70% higher, right? It's
Yeah.
not even more. It's even more. Yeah. I mean, so that's anyway.
No, that
Yeah.
makes, I think I was listening to an investor like Warren Buffett or something, or some follower of his, and he said, I always look, if I can make $5 on every dollar I invest, I don't even enter the deal. Like, that's my minimum criteria for even considering it, that I can make $5 for every dollar, which I thought was very interesting, because that's not really, I grew up reading stock market books. That's not what they really teach you, right?
Wait, but even that, like, if you take out, if you don't take in, or if you don't address the aspect of time,
Yeah,
that doesn't mean anything. Like 5x over 100 years, is that what you're looking for?
right, right.
I
What is that
mean,
time frame? That makes
what's the
sense.
time frame of the 5x? I think it's really important. That's why I think IRR or CAGR are the most important metrics. ROI means nothing.
Yeah.
MOIC means nothing if you don't know how over the time period.
No, that makes a lot of sense. Well, I want to kind of leave this up to you. How do you want to, any advice from our listeners? Where do you see the future going, with AI and real estate, and kind of how are you embracing it?
Yeah, well, I just want to say I do, like, this is a cliche already, but I do believe that AI is like the internet. And back in late I don't know, 90s, early 2000s, if you're in a company that isn't leveraging the internet, you have no right to exist. And so I
Yeah.
think the same is like with AI now. I think every company will have an AI component to it. I think if a company doesn't have an AI component to it, it won't exist in the future. And then I think it's going to be just like an internet. Like, you just have to learn to live with it, leverage it to wherever you think is the future. And obviously, this will create a lot more. Just like, the internet created more jobs, this will create jobs as well. I think that companies will be able to leverage it to bring more value to clients. Yeah, there will be people that are going to lose their jobs because of this. There's no doubt,
Yeah.
and things will become more and more efficient. But I do think there's a lot of opportunities that will come with it. And from a company standpoint, I think it'll be all about the unique data set, and then how do you leverage that data set to bring more value to people and protect the data set. I think that's the future.
That's the moat, right? That we're
Exactly.
yeah.
Exactly.
The data is the moat. It's interesting to me. I mean, that's so important, right? Because a lot of companies have been collecting data for decades, but they never thought about this whole premise of AI. So the data is just very in different locations. It's not well integrated. It hasn't been cleaned up. And so now they're realizing they've been sitting on like gold all this time. And they're like, well, what do we do? What do we do? How do we clean this up so we can actually monetize it? So I think that's
Yeah.
part of the interesting kind of transition that we're seeing. Let's just put AI. I've seen so many AI companies, they say it's an AI company. I'm like, you're not doing any AI. What exactly are you doing? Um, but yeah, I think we're going to
Yeah.
see more and more some of that
You,
fall
you
away.
know, you know, you know what's interesting? In the early 2000s, the early Facebook era,
Yeah.
companies were building, software without any business model because they said, we're just going to create a lot of users and then we're going to be able to monetize using advertising, right? That was like using data. I don't care about the monetization. We'll just have a lot of data, user data, and then we'll
Yeah.
monetize using advertising. And then that switched where that's not a valid business model anymore. You can't think about building a company that's built only on advertising, and you have to start, proving a different monetization channel. And I feel like now we're going back to where data is key. Now it doesn't really matter it doesn't matter your monetization channel. Just build a company that has a unique data set, and then you're going to find a way to leverage that to make money. So it's like a really really interesting cycle we're in,
Yeah.
and curious where it's going to go. So yeah.
It will evolve quickly. That's all I know. I think we're moving through change a lot quicker than we did with the internet. So I think it's going to happen. Whatever it is, it's going to evolve very quickly.
Yeah.
Well, thank you so much, Litan. This was really captivating. I learned a lot. I know our audience as well. So we'll keep talking data, and that's going to help us embrace artificial intelligence in the future.
Thanks for having me. This has been fun. Thank you.
Yeah, thank you so much.